Hello, is it me you're looking for? Chase! What's really good, people? Welcome back to Infant Investors. How you doing? It is, episode 55, episode 54 of the Portfolio Update series. Today we're going to be talking about a lot of things. Dividend cuts. I'm going to talk a bit more about dividend cuts. There's some context that I want to go into. Done a few polls and stuff on the gram, and a lot of you might find some of the results interesting. I'm going to talk about 4 dividend payments that I've received, and I'm going to talk about April the 6th. I'm fresh home, I'm fresh out, and I'm back into the market. They can't hold me back, man. I'm going to do a mezzanine. Maybe not. We'll see. But yeah, if you want to know all of that plus more, like, comment, subscribe, help the channel get to 5k. We can get the word of investing out to more people. Follow on Instagram and on Twitter at Infant Investors. I've been doing a few polls, a few questionnaires and so forth, some of which I'm going to talk about in this video, which hopefully you guys will find insightful. And as the saying goes, the best time to invest was yesterday. The second best time to invest is today. So if you are new to investing, I'm using a free trade platform. I've got my referral link in the description and the pinned comment, freetrade.io/infant-investors. Click on the link, deposit £1, and you will get a free share of up to £200. I've done a video on all of my free shares. I've got, a video I'm probably going to do this week on part 2 of some of my free shares as well. So yeah, it's a good time to actually start investing with prices being so low. But first, as always, let's get into the top movers and the top fallers within my portfolio. And do you know what? It's not been that many movers, mate. It's not been that many movers. It's been a bit of a mad week, which actually for me is a good thing. I've wanted the market to kind of drop a bit more so I can get in at lower prices. But the first top mover that I'm going to mention is my JP Morgan Emerging Markets Government Bond, and that's gone up 0.3%. Listen, as I said, the market's been down. Pretty much all of my stocks have gone down this week, bar 2. And so typically when equities are going down, the bonds either stay flat or they start to rise in a modest way. And that's what you're basically seeing with this JP Morgan Emerging Market Government Bond. It's a bond that I hold to give me a monthly dividend payment, which basically pays for my free trade ISA and gives me a little piece of change on top of that. So yeah, that's the situation with that stock at the moment. The second top mover, which is a very, very interesting one, is Imperial Brands. Now, I've had a very, very turbulent relationship with Imperial Brands, since I started investing in 2018. But this week has gone up 17.29%, which is a pretty significant rise in these current climates. A 20% rise this week in this current climate is pretty significant. So there's a couple of reasons for that. The first of which is that Imperial Brands and British American Tobacco, which is another tobacco stock on the free trade platform, have announced new deals for new credit lines, and they've also mentioned that the pandemic has had a little material effect on their business. So the credit line is basically kind of like an overdraft. It's like saying, look, the money's there, you've got access to this money should things go down. However, you know what, you don't have to touch it. It's there if you need it. That's kind of what people get overdrafts for, or what people should get overdrafts for. What they actually get it for is to do a mezzanine. But listen, we'll just move on to that from now. The second thing is that they've also mentioned that the current coronavirus situation has had a little material impact on the business. I'm reading this from City AM. The cigarette maker said the impact of the coronavirus outbreak on the business has not been material, but if the situation deteriorates or persists for an extended period in key geographies, the risk of a significant adverse impact to the business will increase. Now, that was actually based off BAT, but I think it's the same sentiment for Imperial Brands as well. What we're seeing is that the coronavirus situation hasn't had a material impact on the business, and it's kind of understandable. Let's be honest, I talked about this a lot in the 7 recession strategies video. If you want to know more, click on the link in the description. I will put it in there. But typically in a down market, when things are actually very bearish, and things are in, recession territory, recession climate, whatever you want to kind of call it, people actually flock to bonds, which is one of the things that's gone up this week, and they actually flock to consumer goods and consumer utilities, but particularly tobacco stocks actually start to do well. And let's be honest, right? Tobacco and nicotine is extremely addictive, and so in the best of times, people aren't really giving it up. Much less so in the worst of times. You might have some people that might cut it out. You might have some people that will maintain their habit. You're probably going to have a very big proportion of people that might increase their habit if things are going, bad or sour in their life. So that's why it can be quite a bad thing that it goes up in bad times. more from the ethical standpoint. But if you're thinking purely on a financial aspect, then obviously it's going to be a positive thing for you. So for me personally, it's something that I still need to invest in. I'm still at the moment currently at a loss of 20%, so I'm never going to sell at a loss like that. So I'm still going to invest in. I'm still going to average it down, and we'll see what I'm going to do about that in the future at some point. Now, everything else has been a top faller, and there is a lot to choose from, but I will just talk about the top three. So in position number 3 is Legal and General. So Legal and General has fallen for me this week 16.93%, and I believe one of the reasons why Legal and General has fallen this week is there has been a short seller, a hedge fund, that's announced that they're going to be shorting Legal and General stock. So if you don't know what shorting is, I'm going to give you a very, very tiny overview. Like, this isn't going to give you the full context, but it's just going to give you a flavor of what shorting is. When you're going long on a stock, you basically buy in the hope that the stock price rises, and the difference between what you bought and then a new higher price is basically your profit. When you short, you basically do the opposite thing. You're buying hoping that it goes down. Now, there is a mechanism in terms of how you borrow shares in order to short stocks, and I'm not going to get into all of those mechanics in this video. Might do a separate video, but effectively they've shorted Legal and General stocks. Basically, watch the movie The Big Short. That's going to give you more context anyway. Now, I'm reading this from the Evening Standard. It basically says, I don't know why I repeated that, but Standard: short seller takes £60 million aim at Legal and General amid insurance sector fears over the insurance sector's large exposure to corporate bonds has prompted one hedge fund to go on a hunt for short selling profits. So the bond that I hold is a government bond. It's very worth, whatever. Listen, let me be clear about the distinction. There is a distinction between corporate bonds and government bonds. And the situation is that when times are bad, corporate bonds might default. So, let's say you got a company, right? You got Tesco. Tesco can raise money in two ways. They can either introduce new shares into the market and have people buy equity into the company, or they can release debt into the market and have people basically lend them money of which they have to pay back. And obviously, debt is basically bonds, and that's what that is. That's why it's called fixed income, because when you buy it, you typically get a fixed return of income because that's their payments effectively. Now, if Tesco all of a sudden collapses, they're meant to obviously pay the bondholders first. All of the shareholders probably lose all of their money anyway. But what might happen in this climate is that Tesco, probably not Tesco, but you get the drift, might obviously default on some of those bond payments. So what this hedge fund is basically saying is that because Legal and General has a large exposure to corporate bonds, they expect that a lot of defaults might occur, and if a lot of defaults occur, then they will obviously profit from Legal and General share price tanking if that basically happens. So Marshall Wace, the well-known hedge fund, disclosed a 60 million short position in blue chip insurer Legal and General worth 0.5% of the whole of Legal and General shares. L&G is heavily exposed to corporate bonds, and if the economy tanks and firms default on their debts, the company could take a hit. Now, the article does go on to say, which is more the article's position rather than Marshall Wace's position, it would have to be a doomsday type of disaster to have an impact on a company. The company can withstand billions of pounds of defaults. So this company has obviously done a 60 million short position based on, the fact that it's hoping that it defaults on some of its corporate bonds, etc., that it's insuring. But what the article goes on to say is that it has to be a real doomsday type scenario. Now, listen, the first quarter of 2020 has been kind of peak, so who knows what's going to happen in the second, third, and fourth quarter. But at the moment, I do think it's going to have to be a very, 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 very significant downturn in order for this scenario specifically to materialize. But its exposure has prompted fear in the market, and Marshall Wace's canny computer strategies hope to take advantage. So because of that fear in the market, the share price has gone down, and I think that's definitely one of the reasons. And then it goes on to talk about more on that, but I'll obviously leave the link in the description. The second piece of information for Legal and General, which is actually positive, is that Legal and General announced yesterday that they will continue to pay their £750 million dividend despite the Bank of England warning. So I mentioned in yesterday's video, if you ask 3 out of the 5 banks that we spoke about, did they want to do this, I bet you that 3 out of 5 probably didn't want to, but because of the pressure of everyone else doing it and the Bank of England pressure, they've obviously gone ahead and decided to cut their dividends. Legal and General has basically stood tall, chest out, and be like, you know what, we're still going to pay our dividends. So Legal & General will not be cutting their next dividend. And obviously, what does that mean for me at this current moment? Well, at the moment, I hold 777 shares in Legal & General. So my next dividend payment would be on the 4th of June 2020. It goes ex-div on the 23rd of April. So ex-div basically means that you need to hold the shares by this date to be counted for the next dividend payment. And that date is the 23rd of April. So it's in, you know what I mean? It's in what, 20 days, 19 days, effectively it will go ex-dividend. Now, because obviously I'm losing quite a bit, like, you know, circa 40% basically, I'm definitely going to be trying to average down this position. So I'm going to try and get to, I don't know, maybe 1,500, maybe 1,600 shares. I'm going to put quite a bit of money into Legal & General. One, that's going to make my dividend payment around £200 in June, which will be great to receive and great to get, and hopefully those times will be a lot better as well. But two, it's going to definitely average down this position, so I won't be making much of a loss. My current share price, average share price, is £2.65. That will take my average share price much further down. I don't know what it's going to actually take, because I'm not Russell Crowe in that, do you know what I mean? But that watch this button is annoying. But it will drop it down, which is going to be important and beneficial for me. So that's my position on Legal & General, something that I'm still going to continue to invest in. The next top faller has been, you know what it is? It's been Lloyds. Oh man, Lloyds. Lloyds has gone down 17.24%, and as we just spoke about, Lloyds folded under the pressure and they decided to cut their dividend, which obviously has had a big impact in terms of the sentiment around the stock. Listen, a lot of institutional investors rely on the dividends as well as retail investors. So if you guys are selling off, other people are selling off as well, businesses are selling off, and that's one of the reasons why Lloyds has effectively gone down. Listen, I'm just going to be crystal clear on my position. One, as I mentioned, with Legal & General, I'm not going to be losing 50%, so I'm definitely not selling Lloyds. I do care that they're not paying a dividend. They were meant to move quarterly this year. However, I don't care enough to be selling. So I'm going to still be buying Lloyds at a lower price, and I'm still going to be averaging this position down. And currently I hold 3,000 shares in Lloyds. If I can get to maybe 5,000, 7,000, 10,000, who knows, shares by 2021, when they start paying their dividends again, then actually I'll be receiving a lot of significant dividend payments with Lloyds as well. So, I want to be getting into a place where I'm receiving £100 in dividend payments on a consistent basis. So, you know what, that's what I'm going to do with Lloyds, and I'm just going to keep on investing for the future. And you know what, you always have to look at the fundamentals. Lloyds last year did 2.9 billion in pre-tax profit. We're all investing in companies that can't turn a profit. Lloyds made 2.9 billion in pre-tax profit. It's still the biggest lender in the UK, and even with the PPI situation, it's still turned around that revenue. So obviously it's going to have a lot of difficult times. We know this. It's going to have to cover a lot of difficult situations where people might be defaulting on mortgages, where people might be defaulting on other personal loans in this current climate. I get that. So I'm not saying that this is the end of it. It might continue to fall. I don't know. All I'm saying is, me personally, I'm just going to keep on investing during these low prices, average this position down, and hopefully in the future it'll be rising again, and I have a lot more shares, and I'll be making a lot more in terms of dividends, which I can obviously reinvest for the future continuously. Now, the next stock and the last top faller is Uber, and Uber has gone down 18%. Listen, last month, or actually this month, it was down to $14 a share. It's currently at $22. So you know what, I kind of want it to fall at least below the $20 mark, but it is something that I'm definitely considering investing. Probably not as a heavy a sum as Legal & General and Lloyds, but definitely an amount that will continue to kind of average this position down. I'm making a loss, 26%, and I'm like, imagine days like before, when I used to have like a 10% loss, it was like, oh my god, the world is falling down 10%. But now 26%, it's like, oh, that's actually good. It's only 26%. It's a sign of the times. Anyway, some of the situations that you might want to be aware of with Uber is that their Uber Rides business, which is their core business, their core bread and butter business, is falling up to 70% in some regions, which is absolutely significant. So you're seeing that in some regions globally, 70% of their core business is basically dropping. Uber Eats business, however, is picking up. So with everyone self-isolating, quarantining, lockdown, whatever you want to call it, actually their Uber Eats business is picking up. People are getting a lot more deliveries, but the Uber Eats business business isn't a profitable business, not like their Uber Rides business. So it's good to see that the Uber Eats business is doing well, but it's not going to be enough to take them on the path to profitability, which they did actually push forward to December 2020 from January 2021. But obviously that's probably definitely not going to be the case now. Currently, I still think if Uber can avoid bankruptcy, I still think Uber's going to bounce back in the future. You know what I mean? It's at one of their, it's at a significant low at the moment. Obviously it's not as bad as it was, you know, a couple of weeks back, but it's still bad. So I'm still going to be putting money into this position, but I will be a little bit more cautious than say I might be with Legal and General and the Lloyds per se. But yeah, it's definitely something I still believe in. I'm still looking at their potential for the future, and I do think that, you know what I mean, in these current bad climate, the bad times, you can actually make a little bit of a profit. Now, I've received 4 dividend payments. So if we go to the activity tab, we can see 4 dividend payments. So the first of which is Imperial Brands, S&P 500, JP Morgan Emerging Markets Government. Listen, that's such a long name. I'm just going to call it James Bond. Like, I'm calling it James Bond from now on. My James Bond and Microsoft. So Microsoft, or Micro Hard, so I'm calling it soft now because it's not doing so well. £2.77 I received on the 12th of March. I received that actually a couple of weeks ago, but I didn't mention it, so I thought to mention it now. My James Bond, £4.11. This is a bond that I have on a monthly dividend. It gives me a monthly dividend payment, as I mentioned before. Pays for my £3 free trade ISA fee, and now obviously I've got a little bit of profit, so I'm just going to continue putting a steady amount. I just average into this. I don't put heavy, I don't go light. I just kind of average into this systemically and at a regular cadence. S&P 500, £4.74. That's obviously my long-term investment. I have not put enough into this, personally speaking, but you know what? Because of the current times, I've definitely been wanting to take advantage of growth stocks. I've definitely been wanting to average down a lot of my positions. I want to take advantage of some of the dividend payments. So I will be putting more money into this to increase this dividend payment, but it's not top of my priorities at the moment. But the last one is Imperial Brands, which has paid me my largest dividend payment that I have ever received, and that is £83.53, as you can currently see. So Imperial Brands basically paid 72 pence per share. They went ex-div on the 20th of February, and their payday was the 31st of March, as you can see, and I currently hold 116 shares, so that's why I received £83.53. Now, this is a quarterly dividend payout. A lot of UK stocks actually only pay semi-annually, with sometimes they pay a special dividend should they receive a lot more in profit. Probably not going to be happening this year, but we shall see. But most companies only pay semi-annually. This is actually one of the very few UK companies that pay quarterly. A lot of UK dividend stocks pay quarterly. In fact, all of the US, a lot of the US dividend stocks pay quarterly, if not all of them. But the dividend stocks in the UK typically don't pay quarterly. Only a few do, and Imperial Brands is one of them. Their next dividend payment will be on the 30th of June. They'll go ex-div on the 21st of May. So if I currently stay with 116 shares, I'll receive £37.70 because they're paying 32 pence per share, which is forecasted for their next dividend. But I'm probably going to add to this position. As I mentioned, I'm 20% down anyway, and I do see that this tobacco industry probably rising during this current climate. Sad to say, but true. So I will be probably putting a little bit more money into there to just ride that, and I'll probably hope that I can receive about a £50 dividend payment in June from Imperial Brands when that actually manifests and comes forward into the future. Now, dividend cuts. There has been a lot of dividend cuts. I mentioned in a previous video about dividend cuts a couple of weeks back. Then I mentioned in yesterday's video about banks doing dividend cuts as well. And, you know, me being a shrewd little sausage that I am, did a pop quiz. I am the shrewd sausage. I haven't got listen, anyway, let's just move on. I did a little pop quiz on the Instagram at Infinite Investors. What percentage of the FTSE 100 have cut their dividends? What percentage of the UK's largest stocks have cut their dividends? And it's very, very interesting to see the results. And I think there's some important takeaways from the results. So 10% of you believe that, 20% of you believe that 10% of the FTSE 100 have cut their stocks, which is cool, interesting. 16% of you believe that 2/3, so 66.666666% have cut their dividends, which is interesting. 44% of you believe that 40% of the FTSE 100, so just less than half, have cut their dividends. But the correct answer was 1/5. So 18% of you, actually 1/5 of you, believe that 1/5 of the FTSE 100 have cut their dividends, and that's the correct answer. Only 20%, only 1/5 of the UK's largest businesses have cut their dividends. So for me, there's two important takeaways. Number one, only 1/5, 20% of the FTSE 100 has cut dividends. So there's 80% of solid UK large cap stocks that haven't yet cut their dividends. Needless to say, they might do so this week, next week, whatever. But at this current juncture, they haven't done so. The article did say that people are going to diversify and move money into stocks that pay dividends. So they're going to basically sell their losing positions because of the cut dividends and then move money into other stocks in the FTSE that will basically pay their dividends. I kind of get it. I kind of get it. Yes and no. Yes and no. Like, yes, it's always good to look for opportunities. But listen, no. Like, no. Don't go chasing dividends. Please stick to the businesses and stocks that listen, you got to listen to TLC in this time. Don't go chasing other stocks just because your stock has decided to cut their dividend. If you're not going to listen to me, listen to TLC. And if you don't know what I'm talking about, then you're too young, darling. Anyway, let me get back to the point. I feel it's a mistake that some people are going to make with, I'm just going to try and grab up the next stock that's basically paying a dividend. So my stock has decided to not pay me a dividend for a 6-month period or whatever, just because of the current coronavirus situation. So you know what I'm going to do? I'm going to sell my losing position, because most likely you're going to be in a losing position, and then I'm going to flood to another stock just to get a bit of a dividend payment, which is going to be one payment. I don't believe in that. That's like when a girl's been hurt by Callum, or Faisal, them sweet man there. Like, a girl's been hurt by Callum or Faisal, and then she thinks, I'm just going to move to Ricardo or Kimbo or someone. Listen, it might look attractive to do that. You might think, all right, cool, I can get a dividend now in the next 2 months, in the next 3 months, whatever. But listen, in the long run, it's probably going to cause you a lot more pain in the long term. You know what I mean? Especially with Kimbo. Listen, you need to, in my eyes, just stick with the stocks that you actually believe in. And if you believe in the stocks and they've cut their dividends, then my personal approach, and obviously I can't advise what you guys should do, but my personal approach would be to average those positions down and put more money in and take advantage of this opportunity. Now, if some of you out there rely on those dividend payments to live, because there will be some of you that, obviously, might be, very wealthy, and actually those dividend payments are your income to live, then I get it, because that actually becomes a different situation. And when I used to work in the bank, there was a lot of older people that actually those dividend payments were salaries for them. And from that standpoint, I kind of get it. But if you're kind of building up your investment portfolio, and those dividend payments are nice to receive, but it's not going to decide whether or not you eat bread and butter or not, then I feel like just stick with the stocks that you actually believe in. Reinvest into Callum and reinvest into Faisal, man. There will be some sunny days ahead. Megan, I'm gonna have to just tell you to just allow it for now. Allow it. The second takeaway from this is the fact that 44% of you felt that nearly half of the FTSE has actually cut their dividends, which is obviously not the case. And I think that just shows the impact of headlines, and the headlines that we're seeing in the market at the moment is just not reflecting the data. You have to take the signal from the noise, and that's what I mentioned in yesterday's video. If I had my own newspaper, what would I call it? The Financial Crimes. No, I'm joking. We're all above board out here. If I had my own newspaper, call it the Dreadlock Standard, the Evening Standard, the Dreadlock Standard. Let me just call it that for now. If I had my own newspaper, I could basically put a headline that says 80% of the safest companies in the UK to not cut dividends. That is factually correct. And actually, what would that do in terms of sentiment in the market? It's going to be more roses and bubbles and cuddles. Do you know what I mean? These headlines will make you scared. They want you to be shook. Do you know what I mean? And either because like Marcus Wace, like Marshall Wace or whatever his name is, whatever the hedge fund name is, either because they're short in the market, so they want you to be scared and sell in your position so that they can profit from your fear, or it sells more of their papers, more impressions, more online digital ad revenue, more paid subscriptions, which again is buying fear. Do you know what I mean? They're making money off your fear. So either way, I think you always have to take headlines with a pinch of salt. Warren Buffett did say this. It's not to say that the news isn't correct, but it's to also say that they've potentially picked what they want to actually tell you. And actually, you know what I mean? It's not the full picture. It's not the whole story. And so you have to kind of look at the whole story. And so really and truly, 80% of the market hasn't cut their dividends. And that for me is a really important thing that needs to be mentioned. Now that might change next week, but I think, you know what I mean, it is really, really important. And so I'm not worried about all of that. Do you know what I mean? I got man in the DMs like my name's Georgia Smith talking about, Curtis, I'm finna sell all my stocks. All your stocks? Like, huh? Scooby-Doo voice. You're going to sell all your stocks? What are you saying? Buy high, sell low. Is that the new strategy? Yeah. Alright, cool. Listen, that can be you in it. But me personally, if you repeat buying high and selling low just because you received all of these bad headlines and you're 40% down here, 20% down here, you know what I mean? You're going to keep on repeating that until you're sitting there under Brighton Pier eating, you know what I mean, seagull leftovers. Like this, what the seagulls didn't even want, and you're eating that. Obviously, God forbid, that's not going to happen. But you get my drift. At the end of the day, you cannot be continuously buying high and selling low just because the market is going down. You should really see it in the inverse reaction, that this is an opportunity. And so when the market goes up, you manage to buy shares at a lower price, and obviously when the market is going up, you'll then sell at that time. And what people tend to do is just the complete opposite. And so it's a lot of investing is just your mindset. A lot of investing is about your mindset, and it's just about how you basically perceive all of the situations. So you really got to look at the fundamentals of each company, and if you're for real about investing for the long term, then that's what's really going to help you. And that's exactly what I'm doing, because it is coming to April the 6th. Right now it's April the 4th. In 2 days, I can invest again. April the 6th is moving like Christmas, Easter, Hanukkah, Eid. You feel me? It's moving like all of the holidays. Like, it's coming like my second birthday. Do you know what I mean? It's coming like the second birthday. Why can only the Queen have 2 birthdays? I'm having 2 birthdays. I'm a king of my ends. Ask about me. Listen, I'm having 2 as well. And people are, you know what I mean, looking forward to April the 6th and looking forward to basically investing. And I'm definitely one of them. And it's going to allow me back into the market. And for me personally, I've been thinking about, you know what, am I going to dollar cost average? Am I going to put money incrementally? Am I going to put some lump sums in? What am I basically going to do? I shared in yesterday's video that the last quarter was the worst first quarter since the Great Depression. Actually, worse, much more worse than the Great Depression, much more worse than Black Monday, much more worse than the 2008 recession. So the last quarter was significant. Like, it dropped about 28%. The Great Depression, Black Monday, the recession dropped about 8% or 9%. So it was a significant time. And so who knows what the second quarter has in store, man. The second quarter could go down quite significantly as well. I personally believe in cash as well, so I'm still toying between the fact of holding a bit more cash, but also trying to take advantage of buying low. So right now, I'm looking at the fundamentals of all of my companies, and I'm deciding, League in General, there's an opportunity there because of their dividend and because it's down so much. Let me go and do so. Lloyds, there's a bit of an opportunity there for the very, very long term, not for the short or medium term, it seems. But what other stock can I potentially go and do? So yeah, that is it for today. Hopefully you found that interesting. Like, comment, subscribe, and I will catch you next time with another investment video. Peace.